non-gold specialists, non-professional managers are beginning to turn to gold. And they're beginning to turn to gold for good reasons, namely that the economic narrative is changing to a narrative that is positive for gold. You know, when you have a weaker economy, cuts in interest rates, inflation that is stubborn and slowly moving up, and a dollar that is falling, that is the ideal environment to be buying gold.
Adrian Day, financial analyst as well as CEO of Adrian Day Asset Management. It is a true pleasure to host you on Palisades Gold Radio today.
Well, thank you for having me. I appreciate it. Look forward.
Excited to hit the ground running, Adrian. Gold futures are trading at around $3,800 an ounce as we speak currently. Potentially a very interesting environment to be looking at gold miners in. But before we do that, talking about the gold price for a second, is there still a fundamental reason to be bullish long term on the gold price?
Oh, absolutely, I think so. I mean, we all know that gold moved up dramatically before the gold stock started to move. So this was let's say, a different kind of bull market that we had. And I think we all know the reasons. The people, the institutions that were buying gold, were buying gold assets, were buying largely for defensive reasons, for insurance reasons, whether it was the central banks, whether it was Chinese non-official buyers, whether it was wealthy families in the Middle East particularly, but also in Asia. They were buying for various reasons, but all of those reasons came down to defensive reasons. And so if that's your motive, you buy physical gold, you don't buy gold stocks. Now, we have to ask ourselves, is that buying likely to continue? When you look at the central banks, dollar assets are now down to about, the last number I saw from the ECB was, European Central Bank, was 47.5% of foreign, central bank foreign reserves were in the dollar. That's down meaningfully from about 65% 5 years ago and about 75% at the beginning of the century. So it's down significantly. But here's the reason. Here's the thing. If you're selling the dollar, and with a lot of those proceeds you're buying gold, if you're selling the dollar because you want to diversify your assets in the face of a fiscal problem in the US and in the face of dollar weaponization, that hasn't changed. Those motives have not changed. And so I would say if 47, let's say 50%, if 50% of your assets are in the dollar and those are your motives, is that still too high a percentage? And I would argue that for many, many of the world central banks, that is still too high a percentage. So I think the selling of the dollar and therefore the buying of gold from central banks is just going to continue for quite a while. When we talk about wealthy people and others concerned about fiscal issues, there's no indication that the fiscal issues are going to change. For the better, I should say, for the better. And so the reasons for buying gold for those people are just continuing. So in short, what I'm saying is that all the reasons people have been buying gold for the last 3 years still exist. And so I would expect us to continue to see gold buying.
Yeah, so if I understand you correctly, Adrian, there's two different buyers that you're outlining here. On the one hand, central banks, stealth buyers just continue to add relatively price agnostic. They don't really care about the price. And if you look at those holdings, those have now slowly grown to a larger percentage than those dollar holdings in the past. Secondly, you're outlining wealthy individuals that are buying gold because of the fiscal situation. So you're talking about government debts that seem unsustainable, and therefore governments might have to print too much currency, which could inflate it, and therefore they're bullish gold. Is that correct?
Yeah. And that's only going to continue, I think.
And talking about a third potential factor, retail buying. Very recently, this chart has been going around on social media. Maybe you have seen this as well. This is the inflows, outflows of the GLD, a fund that's tracking gold bullion. Very recently, it's been going into the green, therefore flowing in from the retail side. Do you think this could be an afterburner for the gold price?
Yeah, no, absolutely. I mean, look, people have been buying physical gold, but not, as this shows, not in any kind of dramatic rush. But just in the last month, we've had $3.3 billion of inflows into the GLD, which is really quite significant. It's not quite showing there, but I looked at the latest numbers just before we started this interview. So I think we've seen a turn, and we've also seen a bit of a turn, not consistent, but a bit of a turning in the flows into GDX and GDXJ. And that is a clear signal, a clear reflection of retail or, individual investors, if you like. They will go for GDX, GDXJ before they start picking individual stocks. And as I say, it's been a bit of a turn. The last month still has net outflows from GDX, which, I mean, just think about it. Look at where the gold price is. Look at what the gold stocks are doing. Look at the margins that they have. There's no other sector in the US with margins as strong and with growth in margins as strong as the gold stocks. And yet in the last month, we've had 330 million of outflows from the GDX, which, I mean, to me is mind-blowing, frankly. But it's been a bit of a turn. You look at the year to date up until, let's say, the third week of August, and you had something like 3.5 billion flow out of the GDX. And we've seen that slowly change, and it was consistent. It was almost week in and week out. There was hardly a week this year that had net inflows. That's changed in the last month. So, I mean, my conclusion from that is that retail, if you want to use the word retail, but also just non-gold specialists, non-professional managers are beginning to turn to gold. And they're beginning to turn to gold for good reasons, namely that the economic narrative is changing to a narrative that is positive for gold. When you have a weaker economy, cuts in interest rates, inflation that is stubborn and slowly moving up, and a dollar that is falling, that is the ideal environment to be buying gold. And the narrative for the last 3 years was quite the opposite. The narrative was a strong economy, high interest rates that Powell didn't want to cut, an inflation rate that had come down sharply from COVID days. So the narrative was of an economic environment that was not conducive to gold. I didn't agree with the narrative, but that was the narrative. And now it's definitely shifting in favor of gold. So I think slowly over time, and then suddenly we're going to start to see more retail, if we want to use the word retail in broad terms, retail interest in gold. But I prefer to think of it as non-specialist interest, which includes retail, but also includes, family offices. It includes mutual funds, frankly, that are not gold funds. It includes any kind of generalist, which we're beginning to see more interest from that sector.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI. With equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold, Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. Yeah, perhaps a generalist investor is a better term. So, three different buyers that we've seen recently. Of course, central banks, wealthy gold buyers, and then now the generalist investor. Looking at perhaps past parallels, historic parallels, how long could this cycle really last if you have those three buyers behind the gold price?
Yeah. Well, you know as well as I do, I hope you know, I mean, I hope people know that gold cycles tend to be long. So, and obviously you can determine based on corrections where you start and stop your cycle. But just look at the last cycles. We went from 1971, which was an artificial start because that's when gold was freed. But 1971 to 1980, that's a decade. We went from 2001 to 2011. That's a decade as well. If you go back over 300 years, you find that gold cycles up and down have tended to last for between 15 and 30 years. So gold cycles tend to be long, and even in the modern era, they're decade-long cycles, much longer than other cycles typically. So I would argue that we're still, in terms of gold, we're still relatively early, not at the beginning, but relatively early. The big question to me, well, the two big questions are, how far down do central banks want to take their dollar holdings? And for some countries, like Russia, the answer is to zero. I think China is probably going in that direction, but maybe will stop before they get to zero. Now, obviously, for Britain and Germany, well, I don't know if Britain owns any gold anymore, but for France and Germany and Italy, they don't need to go to zero. They're not overly worried about dollar weaponization, but they are worried about just diversifying their assets out of a currency of a country that has such awful fiscal deficits. There's economic reasons as well as geopolitical reasons to reduce your dollar exposure. So, I mean, I think, so yeah, I think we're closer to the beginning than we are to the end. When it comes to gold stocks, frankly, I think we're very, very close to the beginning because generalists have only just started coming into this sector.
Talking about the dollar for a second, I believe last time we spoke, you referenced that the dollar might be an interesting value proposition by itself. Can you take us along really why the dollar is so weak currently and what effect the Federal Reserve cutting the interest rates with 25 basis points could have on the dollar?
Yeah, no, good question. I was wrong on that one, wasn't I? Depends when we talked, of course. Yeah, I mean, look, the dollar has had the largest first half of the year decline since 1973 or 1974, I forget which. But for 50 years, it's the largest first half decline in 50 years. So frankly, I thought we might see a bounce at some point, and the bounce we got in at the end of July. Barely recovered 25 percentage points of the 25% of the drop. And since then, as you mentioned, it's just reversed and gone down again. So the dollar is extraordinarily weak. I'm not sure that the cut in interest rates is really what's driving that. Obviously, if the US reduces its interest rates, other things being equal, that's not a positive for the dollar. But I really don't think that's what's driving it. I mean, other central banks around the world have been cutting rates as well. US short-term treasuries are still paying more than most short-term government debt in most major countries. So I'm not sure that's a reason. I think it's concern about the fiscal deficit, as well as a more fundamental reason that we're moving away to some extent from dollar hegemony. And to the extent that the dollar loses its status as the sole and dominant world reserve currency, then to that extent the dollar will lose value against other currencies. I'm not saying, and I chose my words carefully, I'm not saying that I think the dollar is going to be replaced as the world's reserve currency. But in a bipolar world, which a lot of people have talked about, the bipolar and multipolar world, you can have more than one reserve currency. And I think that's the direction in which we're heading. So countries like Britain and Germany, you know, will help you with your defense. You'll have access to our markets. You know, whatever countries you want to mention, you know, you can go with China if you want, but if you go with China, don't think we're going to defend you and don't think you have good access to our markets. So we're moving towards a bipolar world, and you see that even though the dollar remains the largest single asset in central bank reserves. And I know you referenced earlier that graph that's been going around that frankly I think is a bit misleading, referring to treasuries but not to dollar assets. I mean, the dollar is still the largest single asset in central bank reserves. But again, as I mentioned, it's come down dramatically. You know, it was over 75% of central bank reserves were in the dollar in 1999. So this is a long-term trend. This has nothing to do with the current president of the United States, or at least when I say nothing to do with him, it didn't start with him. It's been a long-term trend. You look at, so there's two sides to being a reserve currency. One is, you know, the currency in reserves, and the other one, of course, is the currency in which most global trade takes place. And again, up until 10 years ago, the vast majority, the overwhelming majority of global trade, maybe 80%, don't quote me on that, took place in the dollar. But over the last several years, and again, this predated the current administration, over the last several years, that percentage has significantly declined as different countries like Brazil and China, or like Saudi Arabia and China, Russia and China, are making their own bilateral agreements to trade in other currencies. And so the dollar is definitely losing its sole status as a world's reserve currency.
Incredible, insightful. Thank you, Adrian, for taking us along there. Can you talk to us about silver for a second? Of course, a precious metal, also an industrial metal. It's currently flirting with around $45 an ounce on the futures market. Is there reason to believe it might go significantly higher?
Yeah, I think there is. I probably shifted my views on silver a little bit. But yeah, we're definitely beginning to see a lot more retail interest in silver. Silver, as we know, silver can typically be much more volatile than gold, both on the upside and the downside. And there are, you know, fundamental reasons for that. We all know that silver has industrial uses as well as precious, monetary uses. So the demand structure is different, but equally the supply structure is different. Most silver produced is byproduct silver, and there are very, very few stockpiles of silver. That's completely opposite from gold, where most gold is primary gold, and there are large stockpiles. I mean, there are huge stockpiles of gold. And so with silver, because you don't have the stockpiles, but can suddenly come onto the market to meet unexpected demand, and because it's a byproduct, meaning that the supply of silver does not respond very well, and certainly not in even the relatively short term. It doesn't respond to increase, or to changes, I should say, to changes in the price. So if the price of silver goes from $20 to $40, the Bolivian tin miner is not going to open a new tin mine because 8% of his revenue comes from silver, right? Conversely, he's not going to close the mine if the price goes down. And that's why silver prices are much more volatile. Then as the silver price starts to move up, retail becomes much more significant for silver than it does for gold. And I think we're seeing some of that now. But by no means are we seeing a mania. By no means. It's a long-winded answer, but yeah, I mean, I think silver could go meaningfully higher. Now, of course, typically silver has that big move at the end of the precious metal cycle. I don't think we're anywhere close to the end of a precious metal cycle. So if silver goes to, pick a number, 50, 60, 70, I don't think that'll be the high for the cycle by any means.
I know, Adrian, you're a fundamentalist, and I know you like focusing on inflows, outflows, things like that. People are talking about a 45-year cup and handle pattern for silver. Is that something you give any credence to?
I'm not a technical analyst, so maybe ask other people.
All right. Can we talk about platinum and palladium for a second? Platinum has had a pretty good year thus far, up 50%. Some fundamental reasons to be bullish on that metal. Is that something that's on your radar?
Not to a large extent. Yeah, there are some fundamental reasons why it's gone up, and I think primarily it's because the expectations for adoption of electric vehicles, which of course use a lot less platinum and palladium than internal combustion engines, was the projections were frankly fanciful. And we're beginning to see that now. So we're beginning to see the adoption slow. Remember, most people at the moment who drive an electric car have two cars. One is for tootling around town or to the nearest charging station, and the other one's for real journeys, right? So in the States, if you want to take a trip from Miami to Atlanta, you probably use your internal combustion car, not your electric vehicle. And so the number of people, so if most electric vehicles are in two vehicle households, the number of households that can afford two vehicles is slowing down, has already, for the most part, got an electric vehicle in the garage. So anyway, the adoption is slowing, and I think that's the main reason that people are buying, that platinum and palladium have moved up. Remember, hybrids also, and there seems to be more of a move to hybrids now among the new buyers, right? So the electric buyers have already got their electric car, and now people who are looking, to reduce the internal combustion engine or whatever it is, for whatever reason, whether it's tax credits or, because they believe in saving the planet or whatever the reason is, those people are now moving more towards hybrids than they did over the last 5 years. And hybrids actually use more platinum than an internal combustion engine, which is quite astonishing. So I think that's the main reason that they've gone up. For me, we tend to buy stocks. Now, of course, we do buy physical ETFs, like the uranium ETF or closed-end fund, actually, but the uranium trust, the silver and gold closed-end funds. We do buy those, and there are platinum and palladium closed-end funds. But most of what we do is in equities of the miners, equities of the explorers. And when you look at the equities, you have a real problem because most of the platinum and palladium comes from either Russia or South Africa. Russia's off limits, and now you're looking at South Africa is not a country I want to have too much exposure to. And so when you look outside of those countries, you've really only got a tiny handful of real companies in that space. I prefer with platinum and palladium, just as I prefer with lithium and a lot of smaller rare earths and so on, I prefer to get that exposure inside of a company that I like anyway. So for example, Franco-Nevada has quite high exposure to the Stillwater mine in oh my gosh, is that Montana? My flow suddenly stopped. Anyway, Stillwater mine in the United States. So they've got a royalty on that. So I get exposure to platinum and palladium. That's more a palladium than a platinum mine. I get exposure through a company like that, which I like anyway. I get exposure to lithium through an exploration company like Midland, which has a joint venture with Rio Tinto. And I like Midland anyway, so now I'm getting exposure to lithium through that company. Does that make sense?
Definitely makes sense that mine Stillwater was actually in Montana, so good call on that front.
Oh, okay.
Did I understand you correctly that you do have, or you are at least interested in a tiny exposure to direct platinum palladium miners in South Africa?
We don't have any at the moment. No, I don't have any at the moment.
Okay.
Yeah, I want to limit my overall exposure to South Africa. I don't have anything that's non-mining. We do have a couple of gold situations in that country, but yeah.
Understandable jurisdiction, of course, a commodity nowadays. Finding a good jurisdiction to place a mine in is not always easy.
Yeah, no, absolutely. And of course, price typically reflects the political risk. I mean, one of the reasons that Barrick has been much less expensive than its two large competitors, like Nico and Newmont, more undervalued, is because of that higher political risk. So political risk generally, I mean, the question is, do you want a really good mine in a lousy country, or do you want a reasonably good mine in a great country?
That's a great question. Talking about silver miners for a second, of course, also a small market, kind of like platinum and palladium is on the mining front, but there's a bit more diversification in geography. Is that something that you're finding value currently in the silver miners?
Yeah, yes. The problem again is when you look at silver, there are very, very few, because there are very, very few pure silver mines, there are equally few pure silver miners or pure silver explorers. And so even companies we think of as which are silver companies like Pan American Silver, with the second largest reserves of silver of any company in the world, but it only gets 23% of its revenue from silver. And I should correct that. Last year it only got 19% of its revenue from silver, but this year with the addition of Mag Silver that they bought, that will boost it to about 23%. But the point I'm making is that even Pan American Silver, which is the largest, as I say, the largest, second largest reserves of silver, and one of the largest producers of silver, still has a minority of its revenue coming from that metal. So you really have to, there are some silver miners, of course. Fresnillo is one, First Majestic is one. And those tend to be, they tend to be very sensitive. First Majestic is very sensitive to the silver price, tends to get very undervalued in a weak market. It tends to get a little overvalued in a strong market, precisely because there are so few pure silver producers. But we do have some. But again, most of my exposure would be through Pan American Silver. And of course, let's just make this clear. If Escobal comes back on for Guatemala, in Guatemala, that's the fourth largest silver mine in the world. If Pan American brings that back on, then their exposure to silver jumps to over 40%. So, but I prefer to get my silver exposure through companies like Pan American or even Fortuna, which is about the same thing, 20%. Ironically, one of the companies with the largest exposure to silver, not ironically, but people don't think of it, is Wheaton Precious Metals, which has over 40% of its revenue to silver. And I was talking to Randy Smallwood, the CEO, just last week, asking about the 5-year projection. And unless they do a major acquisition, which we don't know about, of course, it'll still be around 40% in 5 years' time. So that's a very good way of getting exposure to silver, a low-risk way of getting exposure to silver.
Really interesting to hear these options to get exposure to silver through different means, not going directly to a miner. Talking about gold miners for a second, if you look at an index like GDX, it's up 120% year to date. Is there still a lot of value to be found in those gold miners because the gold price has gone up more than their price has?
Yeah, absolutely. You're quite right. And the gold price has moved up meaningfully. But when the gold price moves up, you get leveraged increases to the value of your reserves, because not only does the value of reserves go up by the increase in the price of gold, but more of your resources now can move into reserves. So you have a leveraged, so the increase in the value of your reserves and resources is leveraged to the price of gold moving up. Similarly, the cash flows have gone up tremendously. And so, the margin rather, let's start with the margin. The margin has expanded more than the price of gold has moved up. The cash flows have gone up more than the price of gold has gone up. And that, again, that's because those cash flows are leveraged. Because if you have a mine, now you can expand the pit, for example. And the pit expansion 3 years ago was uneconomic, but now with the increase in the price of gold, you can expand the pit for low capital and bring in more ounces. So again, your cash flow will go up at a leveraged basis to the price of gold. And so what I would argue, or not argue, what I would state is that the valuations on the gold stocks today are in some cases a little bit higher than they were a year ago, but they are nowhere near, only 50% of the valuations, which is what you would expect. If Nestle's price doubles, its valuation's half, right? If a widget manufacturer doubles, its valuation's half. That's not the case with commodity or with resource investors. So you look, for example, at Agnico, and I mention Agnico because of the big companies. There's no excuses. Oh, that's cheap because they're in Pakistan, or oh, that's cheap because they just bought Newcrest, or something like that. There's no excuses about Agnico. You look at Agnico, its price to cash flow today is a little bit higher than it was a year ago. And other than last year, it's its lowest price to cash flow in 5 years. I mean, just think about that for a second. Think of what the gold price has done, and yet the valuation of Agnico on that metric is close to the lowest it's been in 5 years. So, and we could go through that exercise with other companies. The price to net asset for Barrick, for example, is still very, very low on a historic basis. So the valuations of these larger companies are still very, very good. And I've forgotten what the question was, but if the question was, is there still value in the big cap stocks? Absolutely.
That was indeed the trend of the question. Talking about some of the smaller producers, if you go down the quality scale or at least the size scale towards, for example, an Equinox that has had some production problems with their restart or at least the startup of their mine, is there more value to be found there if you're willing to look and really sift through these companies?
I think absolutely. No, absolutely. Companies like Equinox or B2 or Fortuna, companies in that, it's a fairly broad range, but in that kind of range, what we might call intermediates or if you like, I think there's definitely more value, but I would say that you need to wait for opportunities to buy. And we get those opportunities. Equinox is a perfect example. As you say, they had the rough startup of Greenstone, their flagship asset. The startup was slower and more problematic than the market was expecting. They had to raise more capital, more dilution. They took on more debt. And so the stock was really floundering. When they did the merger with Calibre, then you got the new CEO come in, Darren Hall. You got a new COO come in, and now you've got Valentine starting up. So you've got Greenstone's problems for the most part are now behind them. So the cash flows can now start to become steady. Valentine has already started up sooner than expected. And of course, with cash flows from two mines, they're going to be able to reduce their debt and improve the balance sheet. So you look at an opportunity like that, and suddenly what's, I won't say a dog, But what's a troubled company that in fact we were selling, I'll admit we were selling, has turned into very good value and potentially, a long-term, a long-term star, if you like, and we've been buying it. They also have the new mine in California, the Castle Mountain. They've also got some assets in Brazil that may or may not be up for sale. I think if they got a good price for them, could get out of, I won't say marginal mines, they are producing money, but get out of some smaller mines and get out of Brazil completely, use that cash to improve their balance sheet. You've got a really solid company, and you can go through each one. I won't go through each one in detail, but B2 obviously had delays, cost overruns and delays getting Goose Bay up and running. Not their fault, by the way, but that's a longer story. But now that Goose Bay seems to be running smoothly, B2 can recover its valuation. Fortuna announced they were closing two depleting mines. One in Mexico, south of Mexico, where they'd had a lot of protests and an environmental agency that seemed to have it in for Fortuna. But the mine was depleting anyway, and so to keep it going, they would have had to put a lot of capital in, a lot of exploration money, and still not know whether it would be successful. And then the other mine, oh gosh, sorry, now they've sold it, I've forgotten the name of it, but in Burkina Faso, so a country that was higher risk for them. Again, a depleting asset. They didn't want to put more money into a high-risk jurisdiction. And in both cases, they were able to sell these mines. Well, guess what? When you sell two mines, your production goes down. Surprise, surprise. And when Fortuna had their quarterly earnings and announced their production was down year on year, the stock sold off by a ridiculous amount, which makes me think it's either algorithms or it's people who just don't follow the company and have no idea what's going on. But anyway, again, a perfect opportunity to buy the stock. So in all three cases, for different reasons, you've had perfect opportunities to buy the stocks over the last 3 months or 2 months, but you do have to follow them a little more closely.
Lots of value to be found if you're willing to put in the work. Talking
Yeah.
about doing some more work and getting some more leverage, juniors, explorers, is that a sector that you're actively looking at right now,
Oh,
heading into this long-term bull market?
absolutely. I mean, that sector's, if we're talking about real juniors and exploration companies, that has hardly budged. I mean, I looked, admittedly it's about 2 weeks ago now, but I looked at the, what do they call it, the S&P, Toronto, Vancouver, metals and mining index or something. They need to get a catchy name for that. But anyway, and it was up like 6% in 3 years. I mean, nothing. And all of that, virtually all of that gain was from a small minority of companies that had done very well. So the broad mass, the rising tide has not even started to lift all boats yet. And there's some really good companies, and I could name some, but I'm not trying to pick on a particular company, but a company like Midland, for example, which in my view is a really solid company, good management, good technical team, good balance sheet, lots of projects in Quebec, a good jurisdiction, lots of joint ventures and alliances with some of the biggest companies, in the world, and they just, frankly, simply haven't had that big success. Whether you're a joint venture company or you're doing your own exploration, you've still got to have that big success, right? So you look at companies like Midland, and it started to move now, but I would say there's a lot of companies like that out there that are really good quality, doing really good work, and will respond very, very well to, a discovery or something like that.
And timelines for really that junior sector to take off. Of course, a rising tide lifts all boats. That's kind of what we're potentially talking about in a longer term bull market. What type of timeline should we be thinking about?
Um, well, it takes a long time. There's no question. I like to think back to Virginia Gold. You may remember that one, and older people still thank me for recommending Virginia. They forget that when we first bought Virginia at $1.50, it fell all the way down to 35 cents before eventually selling them. They sold their Discovery twice, incidentally. Once they sold the royalty, and once they sold the project and kept the royalty, then they sold the royalty. But anyway, they forget that was 10 years. That was 10 years. But you were dealing during that time. I would say, even though it did go from $1.50 back to 35 cents, which that's going to hurt anyone. But when you've got great management, by great I mean everything: ethical, hardworking, competent. And you've got a range of projects that they're working on, you've got a lot of joint ventures, you've got cash, you can afford to be patient. Now, some people prefer to wait until they make the discovery, pay a higher price, but compress the time frame that you have to wait. And that's fine too, it just depends on your style. But there are companies like Virginia, that doesn't exist anymore, of course, but companies like Virginia that I'm just perfectly comfortable to have in my portfolio and to hold. You don't want your entire portfolio to be like that, but I don't think a decade is too long of a time frame for those kind of stocks, frankly. Remember, we're not talking with companies like Virginia or now with Midland. We're not talking about one drill hole, one project with one drill campaign, and it's either a success or a failure, and then we move on. We're talking about a company as a business, a company that has a business plan that's just building value over time.
Great points. Last real topic I want to talk about is oil and gas. Of course, it's a completely different sector. What is your view on that sector? Are we at a low point? Is it perhaps an interesting time to be looking at some oil companies that are paying some juicy dividends?
Yeah, well, first of all, I want to really make the point that I don't think that we as investors have to, all the time, have a view on markets and sectors, however important those sectors are. So for me right now with oil, I'm sort of conflicted. I'm not, over a 5-year period, I suspect is going to do well. The whole commodity complex is going to do well. The whole commodity complex is basically at a 100-year low relative to financial assets, despite the rally we've had in many sectors in the last year. But if you take a 100-year graph, you can hardly see that blip at the end. So I think the whole complex is going to do well. But within that complex, I have very high conviction on gold. I have very high conviction on silver and on copper and on uranium. I just don't have high conviction on gold, on oil in the near term. I don't feel the need to invest in oil. I don't feel the need to be short oil. I'm sort of neutral. So we've been accumulating slowly some of the better companies, focusing on the E&P companies, exploration and production companies in Canada and in the US, just slowly accumulating them. And these would tend to be companies that have really strong balance sheets, so they can withstand a downturn if it comes, or continued low prices, but also preferably have a dividend, so we're getting some reward while we're waiting, and that's the way I'm playing it. But we're not heavily into oil and gas at the moment.
Talk to us for a second about Adrian Day Asset Management.
Well, thank you very much. So, Yeah, so it's my firm. I started the firm in 1991, so we've been doing it a while, and we manage accounts for, small institutions and individuals, and we manage globally. Most of our accounts are global accounts, but we do have specialized gold and resource accounts. But I mean, we invest. Basically, I like to say we'll invest in any sector and any market, so long as it's something I know something about and can add value. So we don't do much, we don't do any technology or biotech or social media or things that I don't understand, but certainly I don't have any advantage over, other investors. But in the global accounts, we invest in, we're market cap agnostic, so Nestle is one of our largest holdings, for example. And then we go all the way down to 100 million market cap companies in Singapore and in Britain. So market cap agnostic, sector agnostic, so long as I think I understand the sector. And certainly market agnostic. Again, market agnostic, recognizing that if you invest in Sudan, you want to buy a great asset at a big discount over investing in Canada or United States. But we'll invest anywhere in any sector.
Adrian Day, thank you so much for your generosity with your time. Really appreciate it.
Well, thank you very much for asking me. I enjoyed it. That was good.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.